Congress has decided to spend more money over the next couple of years than the previous law allowed, and they increased their forecast for spending as a result. What I found interesting was, as you suggested, that on one hand, they say the deficit's going to be bigger because Congress wants to spend more money. But on the other hand, they moved down their forecast for interest rates quite a bit. They say over the next decade, on average, short-term rates will be 50 basis points lower and long-term rates 80 basis points lower than they had forecast just in January. So it's kind of amazing. The deficit gets bigger, but the interest rate outlook gets lower.
And now you have the people and reportedly even the U.S. considering issuing maybe 50 and 100-year debt.
Yeah, and the Germans sold 30-year bonds at a negative interest rate, yet they're still determined not to spend money on infrastructure. Go figure.
Do you think that we should be taking the market signals seriously in terms of, okay, markets are telling us you should be borrowing right now? I mean, everybody seems to have recognized fiscal discipline for its own sake in a period like this seems to have no meaning or impact.
Well, I think there's more than one thing going on here. If you have a public investment that you think will have a positive return, surely this is the time to do it, even if you have to borrow. Even in the United States, interest rates are still positive, but they're essentially adjusted inflation close to zero. So this would seem a good time to borrow for worthwhile public investments. On the other hand, as CBO points out, spending is growing faster than revenues. Deficits will widen. They'll be very wide compared to historical average. Debt as a percentage of GDP goes up inexorably. We know that can't continue. So at the same time you think about borrowing money from public investment, this would seem a time when, not immediately, but for the long term, you might want to think about how are we going to restrain this spending or raise taxes to close the gap.
Right, but those choices are so difficult that no one will make them until they have to. So where does this leave the Fed? You know, they have the minutes coming out in just 15 minutes time from the last meeting. Jackson Hole, the big confab, a lot to discuss there, especially in terms of the global outlook. If we are going to be now running a larger budget deficit, maybe the president is going to come up with some fiscal measures that add to that. What's the central bank expected to do?
Well, first of all, I think the Fed probably knew everything that was going to be the CBO report in advance. Secondly, the president's already changed his mind about fiscal stimulus. He said today that he's not thinking about a tax cut. I think he got caught in his own contradiction. It's hard to argue that the economy is really strong, but we need to cut taxes to rescue it. I think the Fed is on course to lower interest rates in September, and I'd say 50-50 once more at the end of this year. Why? Because the global outlook is so weak. Manufacturing has been weak. And even though that I don't think the markets are the primary cause, but you can't ignore what the markets are saying.